The smartest financial decision might be the one that looks irrational on paper, because you are not managing a spreadsheet. You are managing a human being, yourself. So, let's dive right into this explainer. Today, we're looking at a massive and honestly kind of dangerous blind spot in how we're all taught to think about money. We are constantly told that finance is just math, right? We're told to optimize the numbers, calculate the exact historical correlations, and just find the perfect, flawless formula. But what if aiming for perfect math actually sets you up for absolute failure? What if the real secret to long-term wealth building isn't about being perfectly rational at all, but instead learning to embrace your own messy emotional flaws?
I really want that idea to sink in for a second, because the absolute truth is the best financial strategy out there isn't mathematically optimal. It's simply the one you can survive emotionally. We spend so much time agonizing over the quote-unquote perfect asset allocation. We try to act like coldly rational robots. But in the real world, a perfectly rational plan can completely shatter the moment you face real fear, genuine uncertainty, or a massive global recession. To win the game of long-term wealth building, you honestly don't need a perfectly optimized spreadsheet. You need a deeply human strategy.
So we often make the catastrophic mistake of viewing personal finance as a hard science, kind of like physics, but it's not. It is actually a soft skill. It is entirely about human behavior under stress. When you're sitting in a quiet, comfortable room looking at historical data, a 30% market crash is just a tiny little blip on a chart. It looks like a great buying opportunity. But when that crash happens in real time, when you're coming home looking at your family and genuinely wondering if your investments are imperiling their entire future, well, that logical brain gets totally hijacked. You are no longer crunching numbers. You are managing your own survival instinct.
So, the absolutely crucial point here is understanding the stark contrast between the cold logic of a spreadsheet and the messy, emotional reality of human beings. Think about it. A spreadsheet doesn't lose sleep at 3 a.m., right? A spreadsheet doesn't feel a sudden sting of jealousy when a neighbor gets rich overnight. A spreadsheet doesn't feel the immense social pressure of wanting to look successful to your peers. But you do. We all do. Which means that acting like you're a rational machine ignores the fundamental reality of just being human.
Section 1. The Fever Paradox.
To truly understand how we handle our money, we actually need to step completely outside the world of finance for a minute. Let's look at a fascinating medical anomaly involving a 19th century psychiatrist named Julius Wagner-Jauregg. Now, he noticed this bizarre pattern. Some patients with severe syphilis actually saw their symptoms improve if they happened to contract a fever from something else. He realized something incredible, something that actually won him a Nobel Prize. Science shows that fevers actively help the body fight off infections. A mere 1-degree increase in your body temperature drastically slows the replication rate of viruses. It is a brilliant evolutionary defense mechanism. So purely scientifically speaking, a fever is a very good thing. Yet, what do? Humans universally treat fevers with medication, simply because they hurt. We take Tylenol. We want the fever gone immediately.
And the core lesson we pull from this paradox is just fascinating. Treating a fever is not perfectly rational from a biological standpoint. If you were a cold, calculating machine, you let the fever run its course to fight the infection faster. But treating the fever is completely reasonable. Why? Because humans naturally want to stop hurting. I mean, I don't care about the clinical data of a double-blind study when I'm shivering under a blanket in total agony. I just want the pill. And your financial decisions work exactly the same way. The pain of a collapsing portfolio feels like a financial fever, and your immediate, deeply human instinct is to make the pain stop, even if the rational move is to just sit there and endure.
Which brings us to arguably the most important definition in this entire explainer. You should not aim to be coldly rational when making financial decisions. Instead, you must aim to be pretty reasonable so you can actually stay invested through the hard times. A reasonable strategy is an imperfect financial plan that you can survive emotionally, socially, and psychologically long enough to actually benefit from it. It acknowledges that you're human. It doesn't optimize for the highest possible return. It optimizes for how well you sleep at night.
Section 2. The Leverage Trap.
Let's move to a famous Yale study that perfectly demonstrates how rational portfolio theory absolutely breaks down when you apply it to real humans in the real world. So back in 2008, two very smart researchers published a paper arguing that young savers should supercharge their retirement accounts using margin, specifically a 2-to-1 margin. This basically means taking on $2 of debt for every $1 of your own money when buying stocks. The theory goes like this. When you're young, you have decades to recover from any losses. Therefore, you should take massive, magnified risks to maximize your exposure to the market early on.
Now, the math on this works flawlessly on a spreadsheet. It literally shows a massive 90% higher return over a saver's lifetime. But
it fails spectacularly emotionally. Because no normal person could watch a 100% wipeout in a market crash and not quit the strategy out of sheer terror. Think about it. With 2-to-1 leverage, a 50% market drop leaves you with absolute zero. A spreadsheet will tell you to just brush it off, blindly follow the model, borrow more money, and start over the next day. But a real human being? They're going to experience a total psychological breakdown, swear off the stock market forever, and maybe even sue their advisor. The strategy is 100% rational and 100% utterly unreasonable.
Section 3. Minimizing future regret.
Staying invested over the long haul matters infinitely more than building the theoretically perfect plan. And look, this isn't just a lesson for amateur investors. It's a philosophy embraced by the absolute pioneers of modern finance. Take Harry Markowitz. The guy literally won a Nobel Prize for exploring the mathematical trade-off between risk and return. He is the father of modern portfolio theory. But when asked how he invested his own retirement money back in the 1950s, he said this: "I visualized my grief if the stock market went way up and I wasn't in it, or if it went way down and I was completely in it. My intention was to minimize my future regret." So he just split his money 50-50 between stocks and bonds. Think about that for a second. The man who literally invented the incredibly complex math for optimal investing completely ignored his own Nobel Prize-winning research when it came to his own savings. He invested his money simply to avoid the emotional agony of regret.
This leads us to a really powerful realization. Loving a technically imperfect strategy actually gives you a massive edge. Why? Because commitment during the lean, scary years always beats abandoning a mathematically perfect plan. There is virtually no financial variable more correlated to success than simple endurance. If you have a mathematically flawed strategy, but it makes you so incredibly anxious that you abandon it during a market crash, well, that strategy is completely worthless. But an okay, kind of imperfect strategy that you genuinely love and that lets you sleep at night so you stick with it for 20 straight years, that strategy is going to make you incredibly wealthy.
Section 4. The value of imperfection. Let's explore some completely normal financial choices that academics might call irrational, but are actually highly reasonable for long-term survival. Academics totally frown on all of these. Take home bias, which is the tendency to invest mostly in companies from your own country. Technically, it's totally irrational to ignore 95% of the planet's markets. But investing is effectively giving your hard-earned money to strangers. If keeping it familiar helps you take that leap of faith and actually stay invested, it's highly reasonable. What about day trading or stock picking? Picking individual stocks is usually a losing game, but doing it with a tiny amount of play money just to scratch an itch so you leave your boring index funds alone? Totally reasonable. Even Jack Bogle, the legendary founder of Vanguard, who famously hated high-fee active funds, actually invested his own money in his son's high-fee active mutual fund. Why? Because family obligations and relationships matter more than maximizing a formula. These are all perfectly reasonable ways that humans navigate fear, family, and social comparison.
So the next time you evaluate how large your emergency fund should be, or whether to pay off a low-interest mortgage, or even what career path to take, you have to ask yourself a deeply practical question. Can you survive your strategy? Are you optimizing your life for perfect math, or are you optimizing for sleeping well at night? Think back to the fever. You can stubbornly let the fever burn because it's technically fighting the infection, or you can take the Tylenol so you can actually get some rest, recover your strength, and live to fight another day. Your finances are exactly the same.
I want to leave you with this final, provocative thought to take away from today's explainer. Stop chasing perfectly rational, mathematically flawless financial decisions. That is a game for cold, unfeeling spreadsheets, not emotional human beings. Start building a financial system you can actually live with. Embrace being pretty reasonable. Recognize that prioritizing your psychological endurance, protecting your peace of mind, and minimizing your future regret is often the absolute only way to stay in the game long enough to actually win. So, I have to ask you, what imperfect, totally reasonable strategy will you adopt today that will finally let you sleep soundly tonight?